How's it going today, guys? In today's episode, I'm continuing my conversation with ChatGPT, but I'm kind of moving on from the farm crisis of the 1980s, and I started talking to ChatGPT about other crises that the Eastern Washington pioneer farmers have endured besides the crisis of the 1980s. And I was doing a little digging and a little research, and I found out about the Panic of 1893 and the wheat price collapse. So I asked ChatGPT, please explain to me in deep detail the Panic of 1893 and the wheat price collapse. What happened? And then ChatGPT responded, here is a deep dive into the Panic of 1893, with a particular emphasis on how the collapse of wheat prices played a crucial role, especially for farming regions such as your focus area in eastern Washington. The Panic of 1893 is often described as the worst economic depression in the U.S. up to that time, stretching from early 1893 into the mid 1890s, roughly until 1897. It was a complex event with multiple causes, like monetary policy, railroad overexpansion, and international capital flows, and multiple effects, like bank failures, business collapses, and widespread unemployment. But one of the threads that links very directly to the farmers, and especially the wheat growers in the West Plains and in regions of eastern Washington, is the collapse of the wheat and more broadly agricultural commodity prices. That link is especially relevant in your story centers on pioneer farming families navigating debt, weather, and global markets, etc. So I will break it down into the following parts. Part 1, the broader economic environment preceding 1893. Part 2, the specific triggers of the Panic of 1893. Part 3, the agricultural and commodity side of the crisis, wheat markets. Part 4, the impact on farmers, especially wheat farmers. Part 5, the regional implications and how the story might look in eastern Washington. And Part 6, the effects and legacy. Part 1, the pre 1893 environment, expansion, speculation, farming boom. In the decades following the Civil War, the 1870s through the 1890s, the United States experienced rapid expansion of agriculture, railroads, and credit. Many farmers, including in the West, took on land, machinery, and debt, encouraged by higher commodity prices and expanding markets. For example, between 1870 and 1890, in many Midwestern and Western states, farm mortgages rose dramatically. One estimate put that by 1890, some 2.3 million farm loans were outstanding, worth more than $2.2 billion. At the same time, farmers expanded acreage, often on marginal land, with high debt burdens. The entry of new lands with the Homestead Act and the railroads opened opportunities, but also a lot of risk. On the commodity side, agricultural production for wheat, corn, and cotton increased faster than population growth, which meant downward pressure on prices even before the crisis. For example, in the Spanish version article, wheat prices fell about 40% between 1870 and 1890. From the railroad and financial side, the 1880s saw a boom of railroad construction, speculative investment in railroads, mining, and land, which built fragile foundations for an economic weakness. Monetary policy. The U.S. was on the gold standard, or moving toward the gold standard, and there was a contentious debate about silver versus gold. The Sherman Silver Purchase Act of 1890 obliged the government to purchase large amounts of silver, adding complexity to monetary stability. In short, many farmers were operating with high debt, heavy use of credit, and facing structural pressures like rising output and stagnant or falling prices, or increasingly global competition. As one article notes, during the 1880s, farmers were overextended with debts and loans. Thus, when trouble hit other sectors like railroads, finance, or commodity markets, it could spill into farming. Part 2. The triggers of the Panic of 1893. Though the wheat price collapse was an important dimension, the crisis has multiple triggers interacting. Some of the key trigger factors were railroad overexpansion and the consequent failures of that. The railroads in the 1880s expanded rapidly, often financed by debt and speculation. By the early 1890s, the returns were faltering. One of the first major failures was the Philadelphia and Reading Railroad, which went into receivership in February 1893. The failure of a major railroad triggered confidence shocks. As one source states, one of the first clear signs of trouble came on February 20th, 1893, with the appointment of the receivers for the Philadelphia and Reading Railroad. Because the railroads were deeply entwined with banks, investors, land speculation, and local economies, their failure spread stress into the banking and business sectors. Monetary credit strain and the gold reserve depletion. Because the U.S. was on the gold standard, or effectively moving toward it, and under pressure from silver purchases, the Treasury's gold reserves were under strain. Foreign investors began to redeem U.S. holdings for gold, and domestic depositors withdrew in fear. By some accounts, European investors pulled money out, causing outflows of gold from the U.S. system. This depletion of reserves undermined confidence in the banking and financial system, leading to runs on banks by depositors and consequent bank failures. International commodity and investment shocks. Global markets also played a role in this. For example, agricultural commodity prices were falling globally, wheat in particular. Some foreign investment bubbles even collapsed. As one synopsis states, investment was encouraged by the Argentine Agent Bank. The 1890 wheat crop failure and a failed coup ended further investments. So U.S. banks and investors exposed to international investments or even influenced by the global commodity prices were affected by this. Agricultural stress. Farmers were already squeezed by falling commodity prices, droughts, oversupply, and debt. When crop failures or low prices happened, especially for export crops like wheat, farmers would begin defaulting on mortgages, and banks that lent to them suffered. Local economies in rural areas faltered. One source states the decline in prices caused grave financial problems for farmers dealing with mortgage debt. Because agriculture was a large part of the economy, especially in the West and up on the plains, this further contributed to economic downturn. chain reaction, and confidence collapse. Once big banks or railroads failed, the losses spread through the economy. Businesses would fail, banks would close, unemployment would rise, credit would contract, further reducing agricultural demand. In short, there was no single cause, but this was a confluence of railroad speculation, monetary strain, international capital flows, commodity price shocks, agricultural distress, and a banking and credit breakdown. Part 3, the agricultural side, the wheat, prices, and markets. Since your interest is in pioneer farmers and you mentioned wheat, let's focus in more detail on how wheat and grain farming fit into this crisis. A pre-crisis wheat environment. By the late 19th century, the U.S. had become one of the world's major wheat producers and exporters. The Great Plains, the Northwest, and other areas like eastern Washington were expanding wheat acreage. As a global transport improved, with railroads, grain elevators, and shipping, wheat could be moved from interior farms to ports and to export markets. With that being said, this expansion of acreage and output placed downward pressure on prices over time. Even before the panic, farmers recognized that more output didn't guarantee more income if the price dropped. For example, between 1870 and 1890, wheat prices fell 40%. Many wheat farmers took on mortgages or credit, expecting that export markets and high yields would enable them to pay back the debt. This assumption was that the breadbasket role would continue to deliver strong prices. The collapse of wheat prices. Now, several things happened around 1892 and 1893 that accelerated the collapse of wheat prices. According to one source, Eastern Washington, the price of wheat fell from about 57 cents a bushel in 1892 to about 40 cents in 1893. Another source states that when the price of a bushel of wheat fell from 83 cents to 62 cents, from 1892 to 1893, note the dollar values may differ depending on region or reference, but you get the idea nonetheless. A dedicated agricultural historical article states that it shows that after 1893 there was a global glut in wheat supply. For example, in 1893, Russia produced 38% more wheat, and Argentina also exported a large percentage of its production, which created global oversupply and depressed world prices. The same article states this glut of 1893 established a new and lower floor for the international price of wheat. So wheat prices did not just drop because of domestic overproduction. They were also driven by a global supply increase and a falling demand for export opportunity, which meant that the American wheat farmers faced falling prices even when their production was good. Other pressures on wheat farmers. In addition to falling price per bushel, there were additional costs and structural stresses. Transportation and shipping costs. Though rail rates did drop, which might seem helpful, the drop in price and the drop in freight meant margins were squeezed. One source states that in 1894, the rate for a bushel of wheat by rail dropped from 14.7 cents in 1893 to 12.88 cents. Weather and crop damage, for instance, in eastern Washington, one account from HistoryLink says that in 1893, Early fall rains destroyed about half the wheat harvests. Not purely price effect, but yield loss piled on top of price loss. In 1893, the price of wheat had fallen to 40 cents a bushel, but the crop appeared to be one of the best ever. Then, early in the fall harvest season, the rains came, and 50% of the crop was destroyed. Then there were debt burdens. Many wheat farmers had mortgages or had borrowed for seed, machinery, or land purchasing and expansion. With a lower income from harvest and a falling price, paying the debt became more and more difficult. Then there was exposure to export markets. As global supply rose, competition from other wheat producing regions like Russia and Argentina meant that the U.S. farmers could not rely indefinitely on high export prices. Because the wheat farmers were part of the broader economy, they borrowed from the banks, bought heavy machinery or seed on credit, paid freight, or sold to elevators that use credit. The stress from the wheat price collapse fed into the financial system. Farmers earning less could not pay mortgages or loans, which meant that the banks suffered loan losses. For example, the hypothesis that the collapse of the high-risk mortgage market explains many failures in the 1890s. Banks with losses reduce their lending or fail, which mean businesses and farms find credit more expensive or harder to get. Political and moral pressure around the farm distress and the need for the relief increased. There was a fall in agricultural incomes that further reduced demand for goods in rural towns, affecting the railroads and freight even more. As the financial panic deepened, credit contraction made it worse for the farmers. They had fewer options to refinance or borrow. In short, a failing commodity price, wheat, for example, in this situation, that hits a major agricultural sector becomes not just a farm problem, it becomes a systemic problem because of the web of credit, land, banks, and transport.